Hey everyone, happy Thursday, January 16th. It's a little bit before 10 a.m. on the West Coast, and it's time for another market update. Last week was a little light on data. This week is heavy on data. Two really important reports going back to last Friday. We got the BLS jobs report, and then we got some inflation reports. Diving right into it. First one, going back to last Friday, we got the big December BLS jobs report, and as expected, or actually worse than expected, it was another bad report for rates. So this is one that's obviously hurt us for years now. It seems like in the mortgage industry, there's generally more jobs are created than expected, and then they go back and negatively revise it, but we don't get the same effects. So taking a closer look at that, as I said, better than expectations, worse for us than expectations. Seasonally adjusted jobs were up 256,000. Only 160,000 were estimated. Non-seasonally adjusted down 81,000, and then they did make a negative revision over the last 2 months of 8,000 jobs. Pretty spread out government between government, healthcare, education, leisure, hospitality. The four main ones. Interesting to look at government upcoming with new administration and Elon Musk and his Doge. Going into government efficiency and maybe cutting some of those jobs. We'll have to keep an eye on that. So that was the business establishment survey where they do some math. The household survey where they actually call people and talk to them about, are you looking for a job? Have you applied for a job? That kind of thing. That is where we get an unemployment rate from. And the unemployment rate jumped from 4.1%. Or I'm sorry, jumped would have been good for us, dropped from 4.2% to 4.1%. So it was expected to stay at 4.2. It dropped unexpectedly. There was 478,000 jobs created according to this survey, and the labor force only increased by 243. So that's why you get that drop. And then the all-encompassing, the U6 number, where they don't take people out if they haven't applied for a job, that kind of thing. That is still pretty high at 7.5, but did drop from 7.7. And there's something interesting to look at. The average amount of time people are on unemployment is increasing. Last December was at 22.2 weeks. Now it's at 23.7. So people having to stay on unemployment longer and longer and longer doesn't necessarily scream strength for the job market. Here's something from the household survey. There's 478,000 jobs created, but 359,000 of them were 24 and under, and 224,000 were 16 to 19-year-olds. So this looks like a lot of seasonal hiring in December, for the holidays. Great for these young kids to get jobs, but that's obviously not the big job group. It's not the 20, the 35 to 50-year-olds, that sort of numbers. But that's a big part of these 478. Looks like it was seasonal, so that's something to keep an eye on. And then the only part about this report that was kind of positive for us was average weekly earnings, or hourly earnings, and weekly earnings dropped slightly from 4 to 3.9 and 3.7 to 3.6. The reason that is good for us is that the more we make in this country, the more we spend. That's inflationary. So we all look at that. So that dropping was one small nugget of positivity. So bad report as usual, it seems like, with the BLS. Next report was yesterday we got December CPI inflation report. The Fed's favorite inflation is PCE, but CPI is another important one. And as I say here, the core part of it cooled, which was really good for mortgage bonds. So we'll get into. So the headline part, which includes everything, that went up 0.4 month over month. The year over year went from 2.8 to 2.9. Energy costs were a big part of it. Food was also up quite a bit. Again, those two numbers are taken out of the core number. And then shelter is part of this, and that is been a big driver, obviously, with the headline numbers. And then, but if you take all those three out, the rest of everything else in this country is just up 0.08 month over month. So pretty small number. But again, energy and food were the main drivers there. The core number, where again they take out food and energy costs because the Fed doesn't think they can control anything. They can't control food and energy. Food can be affected by famine or harvest things in Ukraine, whereas energy can be affected by oil and Middle East stuff. So the core was up 0.2% month over month. Year over year dropped from 3.3 to 3.2, which was great to see. A lot of people were thinking that month over month number would be 0.3, even 0.4. Shelter, came in a little bit better than expected, or better than we had been getting. We know this should be coming down. Rent was a decent number. Lodging away was a negative number, where last month it was a big positive number, which is like hotels and Airbnbs. And then owner's equivalent rent was a big part of it. Owner's equivalent rent is just like when they ask homeowners how much they would rent their house for. So that just doesn't seem like the best number to go by, because most people are going to overestimate what their house is worth and what they can rent for. So that was the one part that was a little higher than expected in shelter. And then used cars up month over month, still down year over year. Airline fares is up, but this is an example of where the Fed tries to take food and energy prices out of the core, but airline fares are up because energy prices were up. So if the fuel for the planes is up, then our fares are going to go up. So that's an interesting spot where it filters through in the report. Motor vehicle insurance is now just up 11.3% year over year. Remember that number is up over 25%. So good to see it moderating, but maybe, beginning of the year, maybe there'll be some increases there. And so everything else in the core was just up a 0.02% month over month. So pretty good CPI report, help mortgage bonds quite a bit yesterday. Next thing we got was PPI, so producer inflation. Producer inflation came in better than expected. This is good for PCE because some of these numbers get put into the PCE inflation report later in the year or later in the month. It was up 0.2% month over month. It was expected to be up to 0.4%. Year over year did go up to 3.3%, but that was because it was a really small number last year, a negative number. And then the core was flat. It was up 0% month over month. So that was good to see. These are things that hopefully you would hope the producers of this goods would pass it on to us, the consumers, when their inflation comes down, but we shall see. Miscellaneous stuff. So December retail sales, how much money we're spending in this country, those were better than expected. It was up 0.4%, was expected to be up 0.6%, but the core number on there actually jumped quite a bit. It was supposed to be about 0.4% up, and it went up 0.7%. And that's something that gets put into our GDP. So again, Americans spending too much money, that's inflationary. We got to stop doing that, guys. And then the other part, ghost jobs. This was from a Wall Street Journal report. They're reporting, this is something I just talked about with the JOLTS report, job openings. 1 in 5 job openings on these online sites, they say, are not a real posting. It's companies posting these to make themselves look like they're growing, things like that. And like we talked about before, a lot of these are multiple postings anyway. So not only are 1 in 5, do they estimate are ghost postings, so aren't even for real jobs, but then we have the ones that are for real jobs. We have those multiplied because all these online jobs now. So that is just those job openings was a big hurt for us when those came out last week. But just another example of it's inflated. It's ghost jobs. They don't actually exist. It's a bunch of malarkey. Initial jobless claims came out 217,000. Expectations was 210,000. Still really low, and this could be people catching up after the holidays. So something that better than it being a lot lower than expected, but not wasn't a big market driver. Average 30-year is down from 7.15 to 7.11. Again, this average 30-year conventional for top 10, it's a lender survey, so it's the median basically. For good borrowers, let's say 40% or down, 740 credit scores. This actually had jumped to 7.25 middle of the week. So inflation coming down yesterday and the day before, got us down to the 7.11 number. So that was good to see, at least some positive movement. Important dates. We got the Fed. Their meeting is on January 29th. Right now, it's about 95.5 that they pause. They don't cut. Only a 5% chance they cut. I don't know if we're going to get there. If there's any data that'll come out before, because we get the next big inflation report and the next big jobs report after they meet. So expectations is pretty firm that we will get a pause. No sort of cut on January 29th is not great, but it is what it is. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, everybody have a great week. Thanks, guys.